Welcome back to The Explainer. Today, we're grabbing our trusty stickman animation and building out your ultimate financial tool belt. Because, let's be real, navigating personal finance isn't just about having cash on hand. It's about knowing exactly how to tackle life's major, unavoidable expenses using the right tools at the exact right time. When you use them responsibly, personal loans are incredibly versatile, but you absolutely have to know how they actually work. Picture our stickman protagonist here. He's just going about his business when, bam, he's hit with a barrage of massive life events. A massive storm wrecks his roof, a surprise hospital bill shows up, or maybe he gets a really exciting but super expensive acceptance letter for a career certification. How on earth does he pay for all that without completely wrecking his financial future? Well, he needs to open up his tool belt. So let's get into Section 1, Strategies for Choosing the Right Tool. Now, a personal loan basically hands you a fixed lump sum of cash that you pay back over a set schedule. And the first major strategy for using one, debt consolidation. Imagine taking a messy, chaotic stack of high-interest credit card bills and combining them into one simple, lower-interest monthly payment. By doing this, you're literally lowering the overall cost of your debt because of that reduced rate, and honestly, you're just simplifying your life. One payment means it's way harder to accidentally miss a due date and tank your credit score. What about home improvements? You can totally use a personal loan to fund that dream kitchen remodel or, fix that busted roof we just talked about. The beauty of this strategy is that personal loans are usually unsecured. That means you get fast approval to kick off your project immediately. And this is key. You do it without risking your house as collateral. You're boosting your property value without actually putting the property itself on the line. Pretty smart, right? Then there are unexpected medical bills. When those hit, the panic is real. But our stickman has a plan. For those massive out-of-pocket costs that your insurance just won't cover, a personal loan is often a far better tool than blindly swiping a credit card. It gives you a fixed repayment term and a lower interest rate. So you can handle the emergency without draining your life savings, and you get a predictable monthly budget while you recover. It's also a fantastic strategy for education and career development. Now, you're probably thinking, wait, aren't there student loans for that? Well, yeah, traditional student loans are great, but they usually won't touch things like specialized certification courses, coding boot camps, or niche professional training. A personal loan steps in to offer the flexibility to cover those exact costs, letting you invest in yourself and potentially seriously boost your long-term earning power. You can also use them for major life purchases. We're talking funding a beautiful wedding, a dream vacation, or finally replacing those essential appliances that just died on you. But the big caveat here is discipline. A personal loan is an awesome way to finance these things, but only if you sit down, actually do the math, and make absolutely sure those fixed monthly payments fit comfortably into your regular budget without stressing you out. And of course, sudden emergencies. When something catastrophic happens and you need cash, like right this second, and your emergency fund just won't cut it, personal loans usually offer a much faster approval process compared to other types of financing. You get the funds without delay when you need them the most, plus the peace of mind of a fixed repayment schedule. Moving right along to Section 2, Managing Your Tool, Handle with Care. Look, just like any heavy-duty power tool, a loan can cause some serious damage to your financial house if you mishandle it. Managing it effectively is basically a continuous three-step loop. First, you absolutely have to budget the payment into your monthly expenses before you ever sign the paperwork. Second, you must religiously avoid missed payments. Missing a payment doesn't just slap you with late fees, it damages your credit score, making literally all future borrowing more expensive. And third, always review your situation. If your credit score goes up or market interest rates drop, look into refinancing to secure better terms. So the bottom line is you have to be vigilant. As our stickman navigates these contracts, he needs to watch out for predatory lenders. These are the guys who will try to trap you with excessively high interest rates, hidden origination fees, and brutal prepayment penalties if you dare try to pay the loan off early. Always read the fine print. Actually, scratch that. Scrutinize the fine print, and make sure you completely understand the true annual percentage rate, or APR, before you agree to a single thing. All right, let's jump into Section 3, Alternatives. Opening the rest of the tool belt. First up, the classic credit card. Now, credit card is fantastic for short-term, smaller expenses, and you get the added bonus of earning cashback or travel rewards. But there is a huge catch. Even with those 0% introductory periods, if you can't pay that balance off quickly, a credit card is going to carry a drastically higher interest rate than a personal loan. It's a short-term tool, guys, not a long-term financing strategy. Next up are home equity loans or HELOCs. That's home equity lines of credit. Because these tools actually use the equity in your house as collateral, they generally offer lower interest rates than unsecured personal loans. That makes them super cost-effective for the really massive expenses. However, the trade-off is that the application process takes way longer, involves a mountain of paperwork, and is just significantly more complex. And there is a massive, neon-flashing warning sign with home equity financing. Using your home as collateral means you risk losing your home if you default. It's an incredibly powerful tool with great rates, but if your financial situation goes south and you can't make the payments, you literally risk facing foreclosure. You really have to weigh that risk carefully. Of course, you could always bypass the bank entirely and borrow from family or friends. This is often an interest-free or at least very low-interest alternative, which is great if your credit score isn't stellar. But before you do this, you got to look in the mirror and ask yourself, is this loan really worth the relationship? Mixing money and family can so easily lead to bitter misunderstandings and ruin lifelong connections. If you do go this route, definitely put the terms, the schedule, and all expectations in writing. Finally, the most reliable tool in the whole belt: your personal savings. Using your own cash is undeniably the most cost-effective option because you avoid debt, interest, and lender fees entirely. The only caution here is maintaining balance. You want to use your savings, sure, but be incredibly careful not to completely drain your emergency fund to zero. If you use savings for a major purchase, just make sure you have a solid plan to replenish that fund over time. So, before you rush out to finance your next big life event, take a step back, review your budget, and ask yourself, are you reaching for a tool that will build your financial foundation or one that could tear it down? Thanks for diving into this explainer with us, and happy building.